Most traders think action equals profit. They watch the market like it's a ticking bomb, convinced that every second of inaction is a lost opportunity. Here's the brutal truth. Sometimes the best trade is doing nothing, and it's exactly how Jesse Livermore, one of the greatest traders of all time, banked millions. This is a lesson most amateurs never learn because sitting still feels like weakness, like letting the market pass you by. The amateur sees a gap, a spike, a sudden rally, and jumps in with hope, fear, or greed as their only guides. They trade on impulse, on whispers, on the illusion of control. Professionals, by contrast, understand something that seems almost counterintuitive. The tape doesn't owe you a trade. It whispers its secrets slowly, almost silently. To the untrained eye, nothing happens. But every tick, every shift in volume, every subtle hesitation in price movement tells a story. The difference between you and Livermore wasn't some mystical talent or insider knowledge. It was patience, discipline, and the ability to wait until all conditions aligned perfectly. Take 1,929 as a stark example. The market was in a euphoric rally, and amateurs everywhere were clamoring to ride it higher. Brokers were calling, newspapers were cheering, and every corner seemed filled with the excitement of potential profits. Most traders jumped in on margin, convinced that the upward trend would continue indefinitely. Livermore? He stayed in cash. He observed. He measured. Every small swing, every shift in sector performance, every oddity in the tape was catalogued in his mind. Within days, the market cracked, and those who had blindly chased the rally lost everything they had risked, some even more. Meanwhile, Livermore's silent day strategy positioned him to act at the pivotal point, the moment when conviction and confirmation converged. He entered with perfect timing, and that single disciplined move secured him millions while the masses panicked. Silence in trading is far from laziness. It's not avoidance, it's positioning. It's waiting for the tape to confirm, not your gut. The amateur reacts to emotion, fear, greed, excitement. The professional, in contrast, waits for risk-reward perfection. They understand that the market only gives opportunities when the setup is right. A trade taken prematurely is rarely a winning trade, and even a brilliant idea executed at the wrong time can become a catastrophe. That is why knowing when to step back is as critical as knowing when to strike. Sitting out, observing, taking notes, analyzing patterns, measuring potential pivots. These are not passive acts. They are active strategies, invisible positioning that compounds into profit over time. So, what exactly makes a day silent? It's not the absence of action. It's deliberate, calculated patience. A silent day involves monitoring positions carefully, noting emerging patterns, adjusting stop levels, and decided, planning pyramiding strategies for when the moment to act finally arrives. You're letting the market do the heavy lifting while your mind stays clear, preserving emotional energy and capital for when the perfect trade presents itself. This discipline is something amateurs struggle with because it feels like doing nothing, but in reality, it is one of the most powerful tools a professional trader can wield. Consider this. Many traders believe constant action demonstrates skill. They take dozens of trades a day, trying to capture every micro-movement. Livermore, in contrast, understood that time is the ultimate multiplier of skill. He could spend hours or days doing nothing, yet each silent day added value. Why? Because every day spent observing builds intelligence about market behavior, volume flows, and price tendencies. It's a slow accumulation of edge, quietly compounding until the moment comes to deploy capital with maximal efficiency. This perspective reframes inaction, not as failure or hesitation, but as preparation, as positioning. Think about the psychological impact as well. The amateur who reacts emotionally is constantly under stress, jumping at every fluctuation. The professional, on the other hand, cultivates calm and focus. Silence becomes a tool for mental clarity, for maintaining discipline, for ensuring that every eventual trade is made from a position of strength rather than fear. Livermore mastered this, treating quiet observation as a critical component of his strategy. The 929 market again illustrates the stark contrast. As others panicked or chased rallies, Livermore's patient observation gave him foresight. He wasn't gambling, he was calculating. He knew when the pivotal moment would arrive, and when it did, his actions were decisive and profitable. The amateur, driven by impulse, often mistimed their trades and paid a heavy price. This example highlights the brutal truth. Discipline and patience can make more money than constant action ever will. Every silent day contains lessons that a professional mines for advantage. Each micro-movement, each volume spike, each hesitation in price provides clues about where the market is headed. By taking no immediate action, you conserve not just capital but also mental clarity, emotional control, and analytical bandwidth. This is why Livermore's silent days were not wasted days, they were strategic investments in information and readiness. They allowed him to enter with certainty, not speculation. Here's a hard aphorism to remember. The tape will tell you what to do. If you act first, you're guessing. Every trade taken prematurely is a guess. Every trade taken after confirmation is a calculated strike. That's the essence of professional trading versus amateur trading. The amateur reacts to noise. The professional waits for signal. The silent day also builds confidence. By repeatedly observing without acting, you train yourself to recognize pivotal points. Instinctively, you develop an internal radar for confirmation and conviction, understanding when the risk-reward setup is optimal. Each day spent waiting reinforces the professional identity. The trader who acts only when the market provides clarity, not the trader who chases chaos. So how does one turn a silent day into actionable profit? It starts with mindset. The first step is acknowledging that doing nothing can be the most profitable position you ever hold. Next, it involves creating a system for observation. Track patterns, note anomalies, define key pivot points, and remain disciplined with your preset trading rules. Each silent day compounds into knowledge, which is a form of leverage that amplifies the power of eventual trades. This is where amateur and professional mindsets diverge sharply. The amateur fears inaction and confuses it with failure. The professional sees that patience and observation are weapons. Every market tick you watch without trading is an investment in future profit, in readiness, in timing. Livermore mastered this principle, and it is why he consistently profited while amateurs floundered. By the end of a silent day, a professional trader has not just preserved capital, they have enhanced it through understanding. They are ready to deploy when confirmation arises. The amateur, by contrast, has often expended both capital and emotional energy chasing illusions. This is the brutal truth. The market punishes impatience and rewards preparation. To truly understand the power of the silent day, consider it not as idleness, but as active engagement with the market on a deeper level. You are listening, learning, and preparing. You are cultivating discipline, patience, and mental clarity. You are positioning yourself for the pivotal moment, which, when it arrives, allows for decisive and profitable action. The lesson is clear. Do not fear silence. Do not mistake waiting for weakness. Embrace it as a strategic tool. Recognize that every tick observed, every trend analyzed, and every pivot noted is a step closer to professional mastery. Livermore's millions were built not on reckless action but on the compounded power of silent observation. This is the first step toward understanding the silent day strategy, and it sets the stage for the 3 rules that will transform idle observation into actionable profit. Amateur traders will see this as wasted time, a day without excitement or apparent gains. Professionals know better. Each silent day is an investment in clarity, discipline, and eventual success. In the chapters ahead, you will learn precisely how to define a silent day, how to structure it, and how to extract maximum leverage from it. By embracing the discipline of doing nothing at the right moment, you are positioning yourself to act with confidence, conviction, and precision when the market finally delivers the opportunity. Silence is your weapon. Patience is your leverage. Observation is your capital. The amateur wastes these. The professional compounds them. And it is this mindset, this brutal understanding of waiting, watching, and positioning that separates consistent winners from perpetual losers. The market is never in a hurry. Neither should you be. The tape whispers. The patient listen. The impulsive strike, and the difference shows up in millions. Amateurs jump first, ask questions later. Professionals wait for confirmation before committing capital. That's rule Hasson of a silent day. The distinction may seem subtle, but it is the difference between compounding wealth and compounding losses. Imagine a stock bouncing 3% in pre-market. Your gut screams, buy. Every instinct, every headline, every rumor pushes you to act immediately. But the tape is quiet. Volume is low, key support levels remain untested, and sector performance is ambiguous. In these moments, impulsive traders dive in, risking capital without clarity, while professionals pause and listen. Livermore called this listening to the tape. He refused to commit until multiple signals aligned: volume, price action, sector strength, and the broader market context all confirmed the same story. One misstep, one untimely trade, and even the most promising idea could implode. Confirmation, then, is not a suggestion. It is insurance against emotional overreach. It is the structural backbone of professional trading, a filter separating strategic opportunities from fleeting illusions. The practical takeaway is straightforward. Define your entry criteria clearly before you ever place a trade. Do not bend your rules because of pressure, hype, or fear of missing out. Professionals set precise parameters risk per trade, often between 1 and 2% of total capital, specific pivot points, and stop-loss thresholds, and then patiently wait for the market to reach them. They do not chase, they receive. Amateurs improvise. They trade hope, impulse, and the thrill of movement, often compounding mistakes. They assume that being in the game constantly guarantees success, but the opposite is true. Constant action without confirmation is a fast track to ruin. Mini-maxim: never enter blind. The tape will tell you when to act. This line is deceptively simple but profoundly powerful. It reminds you that the market communicates continuously, and your only responsibility is to interpret signals accurately, not force your agenda. Counterintuitively, doing nothing counts as trading. Every silent day where confirmation fails is not a loss. It is a victory. By sitting on the sidelines, you preserve capital, avoid emotional mistakes, and gather intelligence for future trades. Think of it as compounding patience, the invisible form of leverage that accrues quietly while amateurs are burning margin chasing false breakouts. Every tick you watch without acting is a lesson in discipline and market psychology. Every hesitation, preserved capital that will allow you to take advantage of the inevitable next opportunity. Livermore treated these periods not as idleness, but as strategic positioning. Observation itself becomes an active part of your trading strategy. Consider the mechanics of confirmation. A professional does not look at a single signal in isolation. They consider volume, the behavior of the price, sector trends, market breadth, and even macroeconomic factors that influence risk appetite. Each of these data points is a thread in a larger tapestry. Only when the threads align does the professional commit. Amateurs, in contrast, see a single thread, a spike, a news headline, or a tip and take it as the whole story. The difference is devastating. Professionals enter trades with a high probability of success, while amateurs gamble blindly, often compounding losses. Confirmation is, in essence, the market's way of communicating reliability. Ignoring it is ignoring a roadmap that protects capital and guides execution. Mini story. Imagine a trader watching a biotech stock pre-market. The price jumps 3%. Excitement builds. Margin calls flash. Every colleague is diving in. The amateur buys immediately, convinced that missing the first wave is fatal. Within an hour, the rally stalls. Volume dries up, the stock reverses, losses mount. Now contrast that with a professional using rule hash shown. They observe, they check sector performance, they examine broader market sentiment, they wait for volume and price to confirm a genuine trend. When the confirmation arrives, they act decisively, with precision and risk under control. The outcome is entirely different. One acts on emotion, one acts on intelligence. The result is the difference between compounding losses and compounding profits. Another dimension of confirmation is psychological. The amateur, rushing to act, is reacting to fear and greed, emotions that distort perception. Professionals, on the other hand, build emotional distance from the market. Confirmation becomes a tangible criterion, independent of desire or impatience. It transforms trading from a guessing game into a methodical process. Every silent day waiting for alignment strengthens emotional discipline, reinforces patience, and builds confidence in execution. Confirmation also allows for controlled risk management. When multiple signals align, you can size your positions appropriately, set meaningful stops, and anticipate profit targets. When signals are absent or contradictory, inaction is the only rational choice. Professionals understand that missing a trade is preferable to losing capital unnecessarily. The amateur does not. They trade every signal, every tip, every impulse, believing that activity equals skill, when in fact it often equals exposure to ruin. Here's a rule to internalize. Confirmation is the market's way of filtering opportunities. It is not optional. Without it, you are gambling. With it, you are trading with the tape as your guide. Silence during. Uncertainty is not weakness. It is strength. The ability to step back, observe, and demand clarity is the hallmark of the professional trader. Every day spent waiting compounds knowledge, discipline, and the likelihood of profitable execution. Mini maxim repeated. Never enter blind. The tape will tell you when to act. Memorize it. Let it anchor your behavior. Let it guide your decisions. And recognize that every moment spent observing is an active investment in future success. Doing nothing when confirmation is absent preserves not just capital but the ability to act decisively when conditions align perfectly. As you continue to refine your trading approach, remember that confirmation requires structure. Define exact entry parameters, pivot points, stop-loss thresholds, and volume or sector requirements. Treat these criteria as inviolable. The professional does not bend them for convenience or emotion. Each rule ignored is a risk, and the market is unforgiving. By waiting for support, confirmation, you create a measurable advantage over amateurs who trade on impulse and emotion. The counterintuitive truth is that every day without action builds your edge. Each day observing, noting anomalies, and waiting for alignment strengthens your intuition and reinforces strategic thinking. These silent days are not wasted. They are leveraged periods of preparation, allowing compounding patience to work quietly while others rush and fail. You are cultivating discipline, focus, and clarity, and these qualities compound faster than raw speculation ever could. Consider again the psychological divide. Amateurs see a quiet tape and feel pressure to act. Professionals see the same tape and smile, knowing that clarity is imminent if they wait. The ability to resist pressure, to ignore noise, and to act only when confirmation arrives is the central difference between professional results and amateur frustration. Observation, patience, and structured confirmation are more profitable than impulsive execution. Finally, the cliffhanger. Even with perfect confirmation, one misstep can undo gains. Position sizing, timing, and follow-through remain critical. In the next chapter, we will explore Rule #2, position size, discipline, and why missizing a trade can turn an otherwise perfect signal into catastrophic loss. Understanding confirmation alone is not enough. It must be paired with disciplined sizing and execution to transform opportunity into profit. Confirmation before commitment is the foundation of professional trading. It is the difference between guessing and knowing, between risking capital and leveraging intelligence, between amateur mistakes and disciplined gains. Every silent day spent observing, every moment spent waiting for alignment, compounds into readiness, precision, and confidence. By embracing this rule, you are stepping onto the path of consistent, professional-level trading. Patience, discipline, and observation are not passive, they are active, profitable strategies. Let the tape guide you, let confirmation lead, and let your capital follow strategically. Amateurs over-leverage. They see opportunity and throw every dollar at it, convinced that bigger risk equals bigger reward. Professionals treat every dollar as a soldier in battle, each allocated deliberately and with foresight. Jesse Livermore, one of the greatest traders in history, never risked more than 10% of his capital on a single idea, and often much less. Why? Because a single loss should never threaten survival, and survival is the ultimate prerequisite for profit. Consider a trader who sees a breakout and impulsively allocates 50% of his account. The breakout stalls. Panic sets in. Losses spiral. The position that was meant to be an opportunity turns into a catastrophe. Livermore's genius was precisely the opposite. He used tiny calculated positions, observing the trend patiently, and waited for confirmation before committing more capital. Once the trend proved itself, he pyramided, adding small increments as the market moved in his favor. Each step was measured, each risk predefined, and each increment carefully calibrated to preserve the overall integrity of his account. This was not cautiousness, it was strategy. The rule is simple but brutal. Size small, scale slow, protect capital at all costs. Even the perfect signal is meaningless if your position size is reckless, because one ill-sized trade can erase multiple profitable ones. Discipline in sizing is more than arithmetic. It is a mindset. Amateurs act on impulse, driven by greed, excitement, or the fear of missing out. Professionals act on calculation, probability, and preparation. Livermore often emphasized that the key to compounding wealth was control of risk, not chasing illusions of immediate profit. Mini story. In 1927, he entered a lumber trade with positions so small that his activity was barely noticeable in the market. He watched the tape, monitored volume and pivot points, and as confirmation emerged, he added cautiously. By the end of the trade, he banked $1 million without ever exposing himself to catastrophic loss. Contrast that with amateurs who chase early, pile on reckless positions, and frequently blow up. The difference is discipline, patience, and structured action, compounded over time into consistent, outsized results. Pyramiding, the practice of gradually increasing position size as the market confirms your thesis, is a central principle. It allows the trader to participate in gains without overexposure. The amateur, by contrast, often starts too large and adds on emotion, a recipe for disaster. By entering small and scaling methodically, Livermore could multiply profits without risking the integrity of his capital base. Each small, deliberate increment is a vote of confidence backed by evidence, not a leap into chaos. The market rewards precision, not bravado. Every incremental step taken with confidence compounds over time into substantial gains, whereas reckless positioning magnifies losses exponentially. This is why the same signal can produce entirely different results for different traders. Discipline in sizing turns a good trade into a great trade, and a reckless trade into ruin. Counterintuitively, your biggest wins often come from small, confident steps rather than bold, reckless bets. Success is rarely about the size of a single trade. It is about the cumulative effect of controlled, repeated decisions. Waiting for confirmation and sizing deliberately transforms patience into a profit multiplier. Traders who rush, who ignore sizing discipline, are constantly at the mercy of volatility, emotions, and market noise. By contrast, professionals leverage patience and structure to convert risk into opportunity. Every silent day spent observing the tape, noting trends, and preparing to increment positions compounds into intelligence and discipline. Capital is preserved, while knowledge and readiness grow, creating a force multiplier for eventual trades. Position size discipline also serves a psychological function. Knowing that a trade represents a small fraction of total capital allows the professional to stay calm, avoid panic, and follow the system. Amateurs, overexposed and emotionally tethered to every tick, experience fear and greed amplified, leading to poor decisions. Livermore understood that controlling risk was not only about preserving capital, but also about preserving emotional control, which is equally critical in professional trading. The market can take capital quickly, but it can also exploit undisciplined minds just as easily. By sizing small, the professional creates space to act decisively, without emotion, when confirmation arises. Consider the mathematics. Risking 50% of capital on a single position creates a situation where a single failed trade can require a 100% gain to recover. Conversely, risking 2% per position allows a portfolio to endure multiple small losses while maintaining overall growth trajectory. This is why controlled sizing is not optional. It is survival. Livermore's principle of treating every dollar as a soldier in battle ensures that no single trade can threaten survival. The compounding effect of repeated, disciplined gains over time far exceeds the rare windfall of reckless bets. Small positions, scaled gradually, combine patience and intelligence to amplify profits while minimizing risk. Discipline in sizing is inseparable from patience. Even with a confirmed signal, the temptation to overcommit is strong, especially when the tape moves in your favor. Amateurs are often seduced by early gains, adding positions recklessly and converting potential profit into catastrophic loss. Professionals resist this impulse. They understand that scaling should follow a plan, that each increment is a strategic action, and that overall risk management is paramount. This mindset turns market observation and confirmation into actionable advantage. By compounding small, intelligent bets, professionals generate exponential results over time. Mini maxim: your largest wins come from small, confident steps, not bold, reckless bets. Repeat it until it anchors your approach. Each trade executed with discipline reinforces patience, control, and strategic thinking. Each misstep avoided through sizing discipline preserves both capital and confidence. Position size is not merely a number, it is a philosophy. It defines your relationship with risk, your emotional equilibrium, and ultimately, your capacity to profit consistently. Another illustrative story. Consider a speculative sector that suddenly spikes on news. The amateur piles in immediately, risking far more than they can sustain. Within hours, the rally reverses. Losses mount, panic escalates, and accounts collapse. Livermore, entering the same sector, would first observe, then enter in small increments as confirmation emerges. Each increment increases exposure only when evidence validates the thesis. By the end of the move, his total profit dwarfs the amateur's initial bet, achieved without ever endangering the integrity of his account. The lesson is clear. Controlled sizing magnifies gains while protecting survival, turning patience into power. Discipline compounds, both financially and psychologically. By risking small amounts initially, a professional preserves the ability to act decisively on the next opportunity. Capital is never compromised, and confidence grows through repeated successes achieved without emotional compromise. Each increment confirms the efficacy of the system, reinforces adherence to rules, and strengthens resilience against volatility. Amateurs, lacking discipline, repeatedly experience the opposite. Small signals misinterpreted, losses magnified, and emotional exhaustion. This principle naturally leads to the next strategic insight. Observation itself can act as a U position, transforming silent days into active, compounding advantage. But before that, it is critical to internalize the rule of sizing. Treat each dollar as a soldier in battle. Enter small, scale slow, protect capital at all costs. Let confirmation and trend dictate increments, not desire or fear. Discipline, patience, and structured sizing are what convert silent days into profitable action. Finally, understand that risk without control is a recipe for failure, no matter how strong the signal. The most perfect opportunity can be destroyed by reckless exposure. Livermore's methodology demonstrates that a combination of patience, sizing discipline, and calculated pyramiding creates a framework where profits compound and losses remain contained. Size is not just a number, it is the armor that allows you to act when opportunity finally arrives. Small, methodical steps, taken consistently and without emotion, generate results that reckless ambition cannot replicate. By internalizing Rule #2, you position yourself as a professional, protecting both capital and confidence, while transforming silent observation into eventual, substantial gains. Waiting, sizing properly, and pyramiding judiciously are not passive. They are active strategies that convert patience into measurable profit. The market rewards discipline far more consistently than it rewards impulse. Every dollar allocated thoughtfully is a soldier contributing to long-term success. Every increment, a strategic advantage. Next, we will explore Rule #3, observation as a position, the principle that elevates doing nothing into one of the most profitable strategies a trader can wield. Understanding sizing discipline first ensures that when the observation confirms a pivotal point, you can act decisively and safely, compounding patience into real wealth. Here's the paradox. The best position is sometimes no position at all. Observation itself is a trade, a strategic allocation of attention, intelligence rather than capital. Jesse Livermore understood this deeply. He would spend entire days watching the tape, noting key support and resistance levels, volume shifts, and subtle divergences that others missed. Every flicker on the ticker was a piece of data, every hesitation or spike a clue to the market's next move. To amateurs, this looks like idleness. They see a trader not actively buying or selling and assume no work is being done. Professionals know better. Each silent day is a tactical move, a deliberate accumulation of information that compounds over time like interest in a bank account. Livermore treated information as capital, compounding knowledge until the pivotal moment arrived. This is why the phrase "trading with your eyes before your money" became a central tenet of his methodology. Observation is not passive. It is active positioning that allows the trader to enter with confidence and precision when confirmation finally emerges. Mini story. In 1929, Livermore noticed a subtle weakness in railroad stocks. The sector appeared superficially stable, but slight divergences in volume and relative performance hinted at vulnerability. He took no immediate position, choosing instead to watch. By the end of the day, he had enough confirmation to short aggressively. Weeks later, the market validated his observation as the crash unfolded, demonstrating that patience and careful study of the tape could produce profits far beyond what hasty trades might achieve. Livermore's method illustrates that observation is not merely preparation. It is an integral part of the trade itself. By trading with the eyes first, a professional ensures that capital is deployed only when probability favors them. Amateurs, acting impulsively, often risk the same capital without insight, exposing themselves to avoidable losses. The distinction is subtle, yet it separates consistent winners from perpetual losers. Practical takeaway: create an observation journal. Record market pivots, sector anomalies, volume shifts, and unusual price behavior. Treat this journal as a position that appreciates in value over time. Each entry builds your internal map of market behavior, giving you an edge when the perfect signal emerges. By the time action becomes necessary, you are already ahead of the herd, confident and prepared. Observation compounds. The amateur squanders opportunities through impulsive action. The professional accrues knowledge silently, creating leverage without risking a cent. Every minute spent watching the tape is effectively an investment, and when the market eventually aligns with your thesis, that investment pays exponential dividends. Mini maxim. Every minute spent watching is a dollar earned without risking a cent. Internalize this principle. Observation itself is a profit-generating tool, and learning to value time, intelligence, and patience above immediate action is what differentiates the professional mindset from the amateur. Observation also allows you to integrate previous rules, confirmation, and sizing discipline more effectively. Without observing and understanding market context, even perfectly sized positions entered at the wrong time are vulnerable to sudden reversals. By watching, recording, and analyzing, you develop a radar for pivotal points. You learn how sectors rotate, how liquidity flows, and when market participants are likely to overextend. This knowledge acts as a multiplier for every subsequent trade, amplifying the effectiveness of proper sizing and well-timed entries. It is why Livermore could enter trades with confidence that other traders lacked. He had already built a mental map of the market's likely moves. The silent day is, in effect, a preparatory trade in observation currency, which compounds silently until deployed in capital. Consider the psychological dimension. Amateurs often feel compelled to act whenever a perceived opportunity arises. The noise of headlines, broker calls, and price spikes creates tension and urgency. Professionals, however, develop the discipline to resist these pressures. By treating observation as a position, they convert passive waiting into an active strategy. Each pattern noted, each pivot recorded, each anomaly tracked, strengthens confidence and improves execution when confirmation occurs. The act of watching is itself profitable because it positions you to act decisively rather than react emotionally. Livermore's approach exemplifies this. Patience and awareness turned silence into one of his greatest advantages. Observation also cultivates the ability to anticipate pivotal points before they occur. By monitoring volume, sector trends, and price behavior over time, you develop predictive insight rather than reactive reflex. The amateur waits for the move to happen and then reacts, often too late. The professional positions mentally and physically in advance, allowing for rapid, measured execution when the opportunity finally presents itself. Each silent day spent observing reinforces this skill, compounding knowledge and emotional discipline simultaneously. In other words, observation is the multiplier for the first two rules, confirmation and sizing. Without it, both are less effective. With it, they become exponentially more powerful. Mini-story example. A subtle divergence in utility stocks appeared during a quiet session. Amateurs might have ignored it, or worse, reacted prematurely. Livermore tracked it in his observation journal, noting every shift and tick. When broader market signals finally confirmed the weakness he had anticipated, he acted. The entry was precise, capital deployment was measured, and the profit realized far exceeded the gains of any trader acting impulsively. Observation had become a position itself, and its compounding power was evident in the outcome. By internalizing observation as a position, you are training yourself to treat time, attention, and intelligence as assets. Each day spent watching, cataloging, and waiting without acting builds a compounding advantage. It reinforces patience, sharpens analytical skills, and ensures that when confirmation arrives, you can execute flawlessly, deploying capital in alignment with risk management principles. Amateurs see idle days as wasted. Professionals see them as the foundation of strategic advantage. Silent days are not unproductive. They are the architecture of eventual profit. Observation as a position also embeds discipline and emotional control. By remaining engaged mentally without committing capital, you strengthen patience, reduce impulsivity, and improve judgment. Every tick you watch without acting strengthens your ability to wait for confirmation and size correctly when action becomes necessary. This transforms passive observation into an active tool, bridging all previous lessons into a cohesive, high-leverage strategy. Finally, consider the compounding effect. Each observation day builds knowledge. Each recorded pattern reinforces understanding. And every instance of patient waiting strengthens confidence. By the time the trade is executed, the combination of confirmation, sizing discipline, and accumulated observation knowledge produces a multiplicative effect. The professional's silent day transforms into decisive action that far outperforms impulsive attempts. This principle underscores why patience, discipline, and observation are the true currency of professional trading. The cliffhanger: by combining observation, confirmation, and sizing discipline, the silent day evolves from a simple act of waiting into a multiplier of profits, a strategy that outpaces the hasty, reactive behavior of amateurs. In the next chapter, you will see how these three rules interact to generate exponential results, turning disciplined inaction into actionable wealth, and showing why silence often outperforms constant motion in the markets. Here's the ultimate lesson. Confirmation plus proper sizing plus observation equals the silent day multiplier. This is where all previous rules converge into a cohesive, high-leverage strategy. Amateurs see opportunity everywhere and feel compelled to act, believing that more trades equal more profit. They chase noise, rumors, and fleeting price movements, often compounding mistakes into catastrophic losses. Professionals, however, know the truth. The market rewards discipline, not impulsivity. Livermore's formula was deceptively simple. Wait for confirmation, size small, and watch the tape. Then, and only then, act decisively. On the rare days when all signals aligned, he executed trades with precision and devastating effectiveness, converting careful preparation into extraordinary gains. These are the days that separate the professional from the amateur, when patience, observation, and discipline combine to create leverage few traders ever experience. Mini story. During a tech bubble decades later, Livermore identified a pivotal sector showing subtle divergences in volume and rotation relative to the broader market. While amateurs chased every spike, he stayed in cash for days, recording patterns, monitoring sector behavior, and noting shifts in liquidity. Every day of observation was a silent investment, a low-risk accumulation of insight. When the tape finally confirmed his thesis, he entered in small, measured increments. Week after week, as the trend developed, his calculated entries multiplied profits far beyond the impulsive, early bets of amateurs who had overexposed themselves. His patience allowed him to capture the move at its most profitable point, demonstrating that the combination of confirmation, sizing, and observation is more powerful than brute force speculation. This is the essence of the silent day multiplier. Action emerges from preparation, not impulse. Counterintuitive insight. Sometimes sitting out is your most profitable trade of the year, while the spawn dulces, amateur fears missing out. The professional understands that risk management compounds faster than gross speculation. Every day spent observing, every potential entry rejected until confirmation arrives, and every position sized conservatively builds invisible leverage. The edge is in the silence, in the preparation, in the disciplined adherence to the rules others ignore. Each silent day compounds knowledge, emotional control, and capital preservation, allowing decisive trades when probabilities heavily favor the professional. These trades rarely require heroics. They are the product of quiet mastery over process and psychology. Now, let's break this down into actionable steps that integrate all three rules. First, cut losses fast. Every position has a predefined stop. Stick to it relentlessly. The market will punish those who hesitate or rationalize their way through losing trades. Second, size small and scale cautiously. Risk is only meaningful when controlled. Even the best setups can turn against you. Third, wait for confirmation. Signals must align before committing capital, otherwise you are gambling. Fourth, treat observation as a position. Maintain a journal, note patterns, and accumulate intelligence without risking capital. Each entry is a compounding asset. Fifth, own your process. Ignore noise. Headlines, chatter, and peer pressure are distractions. Consistency, not reaction, drives long-term results. Following this framework turns patience into profit, observation into leverage, and discipline into exponential growth. The psychology of the silent day multiplier is profound. Amateurs constantly experience anxiety, compelled to act on every twitch of the market. Professionals, in contrast, embrace calm, knowing that measured action always outweighs impulsive reaction. Livermore understood that the most significant advantage in trading is not luck or intuition, but psychological mastery combined with disciplined methodology, waiting for confirmation, sizing positions carefully, and observing relentlessly removes emotion from execution. Each successful trade reinforces confidence in the system, while each silent day compounds readiness without exposing capital unnecessarily. Mini-story example. Imagine a market with multiple sectors rotating unpredictably. Amateurs jump from one trade to another, taking marginal gains or significant losses, never seeing the full trend develop. Livermore, using the silent day multiplier, watches, notes divergences, sizes small when confirmation arrives, and scales judiciously. Weeks later, the trend emerges precisely as anticipated. The positions he built through observation and disciplined execution generate far more profit than the chaotic trades of impulsive participants. The multiplier effect comes not from the trades themselves, but from the accumulated leverage of preparation, patience, and disciplined sizing. Let's reinforce the mental framework. Every silent day you commit to, observation strengthens your ability to wait for confirmation. Every small, measured entry reinforces sizing discipline. Together, these elements compound, creating a strategic advantage that can multiply returns many times over, far exceeding the chaotic gains of amateurs chasing impulses. The multiplier is invisible until action is taken, yet it is present every moment you resist the urge to act prematurely. This is why professional results feel almost effortless compared to the frantic struggles of novices. Preparation magnifies execution. By combining the three rules, confirmation, position size, discipline, and observation, you convert waiting into leverage, patience into profit, and information into actionable advantage. Each trade executed with this methodology is no longer a gamble but a calculated strike with a high probability of success. The silent day multiplier creates a situation where the market does most of the work, and you deploy capital only when the setup is overwhelmingly favorable. This is the ultimate edge, turning patience into exponential results, while others burn capital and emotion chasing the noise. Closing the loop from Chapter 1, the silent day is not about fear or indecision. It is about control, leverage, and mastery of psychology. By observing the tape, sizing positions correctly, and waiting for confirmation, you can enter with conviction, execute precisely, and extract maximum value from the market's moves. Amateurs act impulsively, risking capital and emotion simultaneously. Professionals act strategically, converting silence and preparation into superior results. The difference between the two is measurable and repeatable. The silent day multiplier is more than a concept. It is a process. Cut losses fast, size small, and scale cautiously. Wait for confirmation. Treat observation as a position. Own your process. Each step reinforces the other, producing a compounding effect that far outpaces reckless trading. When combined, these elements transform patience into profit, positioning into leverage, and discipline into consistent gains. Those who embrace this methodology internalize the professional mindset, leaving the chaos of impulsive markets behind. Finally, the teaser. If you have mastered this framework, the next lesson will reveal how to turn silent days into compounding multi-million-dollar streaks. By leveraging the silent day multiplier consistently, you can build a portfolio and a mindset that outperforms impulsive amateurs year after year. The principles of patience, observation, confirmation, and sizing are not abstract. They are actionable, repeatable, and profitable. Master them, and the market's noise becomes irrelevant.